So I'm Paul Dietmann. I'm with Compeer Financial. Compeer is part of the Farm Credit System. We're a nationwide network of farmer-owned, farmer-led cooperatives. My role with Compeer is I lead our emerging markets program, which is a loan program for farmers who market products directly to consumers or do something with value-added agriculture. And I teach a lot of workshops as part of my job on all sorts of topics related to farm financial management. You've got Andy Larson coming in next week. Andy and I are going to be doing a day-long workshop on April 12th up in Chippewa Falls. That's part of the New Farmer U, being hosted by Marble Seed and Wisconsin Farmers Union. So as soon as we have information available for that, I'll pass that along to Asher and Kristen. So it's a Saturday. Yeah. So yeah, we try to do one or two of these each year, and it'll probably start like 9 in the morning, go to 5 in the afternoon, and we cover a lot of territory in a short amount of time. So, so I'm going to jump into the presentation. I've got really 4 distinct topics that I want to cover today. The first 3 I'm going to go through rather quickly because I really want to focus on the 4th piece of this, which is farm investment analysis. So what we're going to talk about today, we'll start off by talking a little bit about farm loans and about the lending process, what types of loans are available to farmers, what sorts of information we're going to ask for taking a loan application, how we make loan decisions, how to improve your chances of getting a loan if you apply for it. The second thing we're going to talk about is balance sheets. And balance sheets, that's one of the things that we're going to ask for as part of a loan application process. But that's not the only reason to do a balance sheet. It tells you things about your farm operation. It's really important to do a balance sheet every year, at least once a year, updated January 1, December 31. It'll line up with your tax return, and then you can do a full analysis of your farm operation. I'm going to talk a little bit about taxes, just briefly talk about how taxes affect your operation and what it's telling you about your farm. And then like I said, we're going to get into farm investment analysis, and I want to talk about net present value and internal rate of return, which are 2 really important tools if you're trying to build wealth in your farm operation. Knowing these tools, which aren't very common in agriculture, are going to help you a lot. What's the IRR? IRR is internal rate of return, and NPV is net present value. And so we'll get into that later in the presentation. Okay, so we'll start with farm loans and lending. Excuse me. Who lends to farms in the United States? Well, the system that I'm a part of, the Farm Credit System, we're the #1 lender to agriculture in the country. We hold about 44% of all the farm debt in the country. Our system collectively does. Within our territory, and Compeer covers about 2/3 of Wisconsin, the eastern half of Minnesota, the northern half of Illinois. Within our territory, we hold about 50% of all the farm debt. The reason for that is the Farm Credit System was set up back in 1916 by the federal government as a government-sponsored enterprise. And we're still a GSE, still a government-sponsored enterprise, although there's no government money in the system at this point. It's all privately funded. But as cooperatives that were originally organized by the federal government because farmers didn't have access to reliable, affordable credit, that's still our basic mission today. 2 big competitive advantages, the reason that we have so much of the agricultural lending business in the country. #1, we're a cooperative. So we pay dividends back to our members every year based on the profits of the co-op. We actually pay a pretty nice dividend. It's a cash dividend that goes back out to the members every year, between 0.5% and 1% of the average principal on a loan. So it's a significant amount of money. The second thing that's a real competitive advantage for us is that we'll write a long-term fixed rate real estate loan. So we'll often write 30-year fixed rate mortgages on farms. That's almost unheard of outside of the Farm Credit System. So that's why the Farm Credit System is so big and holds so much of the farm debt. All banks in the country put together hold about 35% of the farm debt. Individuals, so if you buy a farm on a land contract, that'd be an individual lender. USDA Farm Service dealer financing. You go to the John Deere dealership and you finance a piece of equipment. That would be dealer financing. Insurance companies. Add all that up, and it totals about 20% of the farm debt. And then we've seen a big increase in the number of non-regulated alternative lenders that are coming into agriculture. Mad Capital, Iroquois Valley Farmland REIT, Steward. There's a number of them that have emerged the last 5 years or so. And they hold less than 1% of all the farm debt. So that's kind of who's lending to farmers right now in the country. So farm loans are a bit different than home loans. So a farm loan is considered to be a commercial loan. It's not a consumer loan. So you've got consumer lending on the home mortgage side. There's a lot of regulations and stuff. Commercial side, there's less regulation. It's pretty open. Pretty much anyone can jump in and start making farm loans. You can't do that with home loans. There's a lot more regulation there. Farm real estate loans generally can't be sold off on the secondary market to Freddie or Fannie. So if you go in and you get a home loan, you take it from your local bank, there's about a 95% chance that loan is going to be sold off on the secondary market to either Freddie or Fannie. What the bank is doing might still continue servicing the loan, but they're passing the risk off to the secondary market. That's why they can offer a 30-year fixed rate mortgage on a home. But with farms, those loans aren't being sold on the secondary market. Our loans are all kept in-house. So if we write a 30-year fixed rate loan, it's on our books. We service it. If there's a loss, we're the ones that take the loss. Our co-op does. Because of that inability to pass the risk off to the secondary market, there are a lot of banks and credit unions that will not touch agriculture. They don't want to do farm loans. It's a segment of agriculture, or a segment of the economy, I should say, that tends to be somewhat volatile too. And the markets are cyclical, things like that. We see what's happening right now with a lot of uncertainty at the federal government level with tariffs and all those sorts of things. Because of that, a lot of banks and credit unions don't want to finance farms. The ones that do, they typically will only offer a 3 or a 5 year adjustable rate mortgage because they don't want to have to take that risk on for 30 years. They'll take it for 3 years or maybe 5 years, but they're holding those loans in-house. If interest rates change, then they're the ones that are at risk. So usually they'll only offer a 3 or 5 year adjustable rate. Interest rates on farm loans, on farm real estate loans, I should say, are typically about 1 to 1.5% higher than a home mortgage. So if you hear that the 30-year fixed rate home mortgage right now is at 6%, we're going to be at 7, maybe 7.5%, because commercial loans are considered to be riskier. There's 3 basic types of farm loans. There are operating loans, intermediate term loans, and long-term loans. Operating loans are typically set up on a 1-year basis. We usually do these as a revolving line of credit. So we'll close a loan with someone. It's in place for 1 year. It matures a year from now. It's theoretically supposed to be paid to zero at some point during the year because it's supposed to be used for operating expenses and it's supposed to be paid down with operating income. Doesn't always work that way. We don't like to see them, I close a loan today, the person maxes it out tomorrow, and a year from now it's still maxed out and nothing's ever been paid down. That's a problem. With an operating loan, it should go up and down through the year, and hopefully we like to see it get to zero at some point because it's really only supposed to be for short-term needs. Intermediate term loans, that's for breeding livestock, it's for equipment, it could be for titled vehicles, movable buildings. These loans are generally up to 7 years. We can do these either with an adjustable rate or with a fixed rate. So we could, with an adjustable rate, it might be fixed for 3 years and then adjustable for the last 4 or something, or it'll be fixed for the whole 7 years. I almost always write fixed rate intermediate term loans. I don't like the fluctuation in the interest rate market. I'd prefer, that somebody takes a loan, they know what the rate's going to be and it's set for the term. Long-term loans, again, those are up to 30 years. That's for real estate. It could be for buildings, those sorts of things. We do these either on an adjustable or fixed rate. Almost all are fixed rate right now. We have a way of lowering the rate over time if interest rates go down. That doesn't require full refinance, so it's easy for us to do a fixed rate note, knowing that we could drop the rate over time if rates come down. So that's a long-term loan. I should have mentioned on operating loans, those rates are always variable. And so a variable rate can change on a monthly basis. And generally, if you hear that the Fed raised rates or lowered rates, our rates are going to follow the Fed. The first of the next month, our rate is going to change by the same percentage that the Fed changed their rate, up or down. So there can be some risk on an operating loan with that, especially if we're in a rate environment where rates are increasing. So maybe, are there any questions about the types of loans or who's involved in the lending business?
When you say there's on the loan to buy a farm 30 years, does it matter if there's a house on that property or not?
Oh yeah, that's a good question. So the question was, if you're looking at a farm real estate loan, does it matter if there's a house on the farm? Generally, it's still considered a farm loan, at least the way we look at it. If the value of the house is more than 50% of the entire value of the farm, then it's considered consumer because the majority of the purpose is consumer purpose. If the value of the house is less, then we consider it a farm and it's a commercial loan and it just goes the normal commercial route. Okay, so applying for a farm loan. Well, what your lender is going to need for a loan application is really going to depend on the type of loan, on the size of the loan, and on the lender. In our program, in our emerging markets program, we have a micro loan. It's up to $75,000. We don't require a lot of documentation. We set up some different underwriting standards for that program because a lot of times we're working with first generation farmers. They maybe don't have much collateral. They don't have a lot of equity, maybe have some issues in their credit history. So we have ways of working in that micro loan that we can make loans under that program that are using different standards than our traditional standards. Generally, what any lender is going to need, and we'd be the same way, whether it's a micro loan or any other type of loan, we're going to at least ask for a balance sheet. And a balance sheet is simply a listing of everything you own and everything you owe. I'll talk more about balance sheets here in a minute, get into a bit more detail on those. Sometimes you've heard this referred to as a personal financial statement. So if you've taken a home loan or if you've gotten a car loan or something, they're going to ask for a personal financial statement listing all your assets and your liabilities. We're going to ask for a projected profit and loss or projected cash flow for a year, and I'll go into examples of these two documents too. We may ask for a simple business plan. So in our microloan, we ask for a business plan. We want something written. Doesn't have to be really long. Usually it's going to be 2 or 3 pages. Just really high level. You know, what are you selling? How are you selling it? How are you pricing your product? What do your financials look like? What are your plans for the future? Who are you? What did you do to prepare yourself for your career in farming? You know, so it doesn't have to be a really lengthy business plan, but we do want to see something. And then we may ask for 3 years of tax returns, or we may not. Generally, if we're running something under a microloan program, we're not going to ask for tax returns. Or if it's an intermediate term loan, we generally don't ask either. If it's real estate, we do ask for 3 years of tax returns because we have to do a little bit more underwriting on a real estate note. But that's essentially what a banker is going to ask you for. It's going to be a balance sheet. It's going to be either a P&L or a cash flow, maybe a simple business plan, and maybe some tax returns. This is an example of a balance sheet. Again, a balance sheet is everything you own, all of your assets, and everything you owe, all of your liabilities. And in a farm balance sheet, we break out the assets in 3 different categories. We have current assets, intermediate assets, and long-term assets. Current assets, this is cash, anything that's going to convert to cash or be used up on the farm within a year's time. And it's typically listed in order of liquidity. So here we've got on the very top line, cash and equivalents. So that'd be your cash, checking, savings account balances. It's your most liquid current asset. You know, if you needed money right away, you can write a check. You can pull some money out of saving. Next is marketable bonds and securities, and then accounts receivable. So accounts receivable, somebody owes you money for something. You sold some hay, somebody owes you money for that hay. That's an account receivable. Should convert to cash within a year, hopefully. That person comes and pays you within a year. It converts to cash, so it's considered a current asset. Market livestock are considered current assets because those are animals that are going to be sold within a year, turned into cash. They're not intended for breeding purposes. They're intended to be sold. Crop inventory, the value of growing crops. Prepaid expenses and supplies. So if you've prepaid for seed, that's something that's going to be used up on the farm within the next year. It's a current asset. So that's current assets. Anything that's cash that will be converted to cash or used up on the farm in a year. Intermediate assets, these are assets that have a life of at least 1 year and less than about 10. So machinery and equipment are a big one. Vehicles, these would be titled vehicles. Breeding livestock falls in this category. So those are the big 3 things that show up as intermediate assets. And then long-term assets, that's farm real estate and also farm buildings and improvement. We separate those 2 categories out. Real estate is not depreciable. Buildings and improvements are depreciable. So we like to track those separately. So we add up all of those assets. In this case, total farm assets, $689,000. And then we move over to the liability side. This is anything that is owed by the farm. Current liabilities, that's anything that's due now or that's going to come due within a year's time. So if you have accounts payable, this is if you bought hay from somebody and you owe money for it, that's an account payable, and that shows up as a current liability. Credit card debt shows up there because that is all due now. It's due and payable, even if you don't necessarily pay it right away. It's still considered a current liability. Operating loans. So if you take an operating loan with us, again, it's going to mature in less than a year, right in 1 year. It's going to be due within a year, so that entire amount is going to show up there. And then any principal that's due within the next year on a longer term loan. So if you've got a farm mortgage and you've got $5,000 of principal that's going to come due within the next year, and then the long-term balance is $200,000, the $5,000 is considered a current liability. It's due within a year's time. The balance of that farm mortgage is going to show up down here as a long-term liability. Intermediate liabilities, those are liabilities that tie to intermediate assets. So if you've taken a loan for a vehicle or for equipment or for breeding livestock, it's going to show up as an intermediate liability. And again, long-term liabilities would be anything related to long-term assets on the balance sheet. If we just take the total assets minus the total liabilities, it gives you an equity position, your total equity. That's essentially the farm owner's ownership interest in their farm. So in this case, they had $689,000 of assets. They had $242,000 of liabilities. So their equity, when we take the assets minus the liability, the equity is $447,000. So if they sell everything on the farm today, pay off all their loans, everything they owe, they should walk away with $447,000. So that's a balance sheet. Yeah.
SCH, parentheses SCH and a number after the items on the balance sheet. Does that refer to something?
Oh yeah. So I should have pointed out that this is a balance sheet summary. So this balance sheet would have supporting schedules behind it. So when someone fills it out, they're actually filling out the supporting schedules, and then those numbers are going to flow forward to this summary. So like where it says Schedule 1, there would be a separate schedule behind this that you would list out all of your checking accounts, your savings accounts, you know, if you had a money market fund or something like that. Then it'll summarize it and move that number up here. And same with like equipment. You know, well, we may have an equipment list that's 2 pages long. And so instead of trying to list that all out here, there's a supporting schedule where you list out all the equipment, and then it all rolls up to this line here where it's a Schedule 5. But thanks for asking that. Good. It's an important question. This is what a P&L looks like, a profit and loss statement. And in the profit and loss statement, we start with income on the top. What are we expecting for income in this farm operation? And then what are all the operating expenses that we have being paid out here? So in this case, I've been doing, lately I've been financing a lot of egg laying barns. So there's a lot of interest in egg laying barns right now because the egg price is really good, right? So this is for a 10,000 hen egg laying barn. We've got 9,700 hens producing because we're looking at potential death loss over a period of time. So we're going to try to figure that out. And then what the yield of the eggs is going to be, how many dozen a day times how many days times what the price per dozen, you know, so we've run all those numbers out. And then we've got at the end of the 14-month cycle, there's going to be hens being sold for $1 a piece. So we have some revenue there. So total revenue, $583,000. We had to buy pullets. We started with 10,000. They cost $7 a piece. We've got feed, which is a huge expense. In this case, I was running this. We're financing this building under a lease program. We have a tax lease program in Compeer, and most of these construction projects I finance under a tax lease instead of doing a loan. And so there's a lease payment in here. There's bedding. There's gas, fuel, and oil. I just made a note about the death loss and how we came up with the total number of hens. Total expenses, $366. So it looks like they could make over $200,000 in this egg laying barn. So pretty decent. But then we like to gather something on the personal side too. In this case, they have off-farm income. That was $55,000. I often will have people break out their housing expenses. Otherwise, we just summarize it down here. So we've got a summary, $48,000. So the net income from the farm is around $216. Net income from non-farm sources after taking out family living costs about $7,000. So that's a P&L. Now the thing with the P&L, we're trying to estimate profit. This isn't necessarily cash flow though, because what we don't include here is if there are principal payments on a loan. In this case, we have the lease, so there isn't a loan. But we would want to include interest expense. We don't include the principal on a loan on a P&L, but we do include the interest. Here we've missed depreciation, and depreciation can be a significant expense that would show up on a P&L. We haven't captured that here. So that's a P&L. There's a few little nuances about a P&L that a farmer was probably going to want to have somebody give them a hand with it the first time they do it.
But you don't have any labor in there.
Yeah, they figure they can do all labor with the family in this case. This is one of my Amish clients, and so they've got a lot of family labor. Yeah, so they're collecting the eggs every day, and they have somebody come in at the end of the term and muck out the barn and stuff. So, yeah. So that's a P&L. We would like to see a cash flow too, and I'll get into cash flow here in a minute. I know you covered cash flow last week, so I don't want to go into too much detail on that. But how does the lender make a loan decision? So if you presented your balance sheet, you presented your P&L, if we needed tax returns, we'd have gathered those. If we needed a business plan, we'd have gathered that too. But now how do we make the loan decision? Well, there's something called the 5 C's of credit. And all lenders pretty much adhere to these 5 C's of credit. So it's character, capital, capacity, collateral, and conditions. Character is, that's where we're pulling a credit bureau report. We're looking at the credit score, the FICO score. We're looking at what you've done to prepare yourself for a career in agriculture. If you grew up on a farm, you've got farm experience. That all plays into the character piece of this. It's pretty subjective for the most part, other than the credit bureau report. Capital, that comes from the balance sheet. We want to see what's your total asset position, what's your equity position, how much debt do you have, what assets do you have that you might be able to pledge as collateral if you're applying for a loan. So that's all coming from the balance sheet. Capacity is coming from the P&L and from the cash flow statement. So that's looking at what's your capacity to service the debt that you're planning on taking on. Collateral is again looking at what do we have to pledge as collateral to support the loan. So if you've got the cash flow for the loan, you've got enough capital, your balance sheet is strong enough. Do you have enough collateral to support however much you're asking to borrow? And then once we've considered those 4 things, then we look at conditions. And conditions might be things like we want to see an updated balance sheet every year. Or we may want to gather your tax return each year. Or we may say you have to keep insurance on the buildings or on the equipment until the loan is paid off. So there may be some conditions that we put on the loan here. But we put those 5 things together, and that's where the loan decision comes from. So any questions on that? Okay. So a few things, if you want to increase your odds of getting approved for a farm loan. Number one, if you can try to build and maintain a FICO score of 670 or above. So when people talk about their credit score, that score can be anywhere from 350 to 850. If you're at 670 or above, and about 70% of the people in the country have a score that's 670 or above, so that's not a very low bar to clear. But if you're at 670 or above, it's going to just make things a lot easier. Doesn't mean that if you're below 670, you can't get a loan. I mentioned I've got a fair number of Amish clients. A lot of them have 0 credit score, or they might have a credit score of 630 because they just haven't used much commercial credit. You know, generally, if you get down in the low 600s or into the 500s, there's some major issue on the credit report. It might be an outstanding judgment. It might be a charge off of similar debt. Medical collections, those sorts of things that can knock your credit score down. But if you can keep a score of 670 or above, it just makes things a lot easier. Pay down your credit cards and pay down your student loan debts. That's probably the 2 biggest areas where I see people run into where we have trouble approving a loan is we'll have people with massive amounts of student loan debt or a lot of credit card debt or multiple credit cards with balances all carried at pretty close to the limits. That's a red flag for a lender. File a Schedule F as soon as you possibly can, especially if you're a young farmer, beginning farmer, you think you might be using the USDA Farm Service Agency Beginning Farmer Down Payment Loan Program. If you can file a Schedule F pretty early, you are establishing yourself as a farm business. You know, the Schedule F is the easiest way to establish yourself as a farm business. And if you've got 2 or 3 years of Schedule F income, it showed that you've operated a farm for 2 or 3 years. And now if you go to the FSA to get a loan, they're going to look at that and say, yeah, you clearly have been farming as an occupation for 2 or 3 years. It's going to make that a lot easier. Build up your cash reserves. You know, building up the working capital side of that balance sheet is really important. I often see people who have very, very little cash, and it's hard to get a loan if you don't have much cash saved up for down payment. Think about maybe taking a small farm operating loan early in your farming career if you think at some point you're going to need a bigger loan. Like you're just getting started farming, you're renting your land, but you want to buy land somewhere down the road. If someone has a loan with us, if it's a small operating loan that's been in place for a few years, you're building up a credit history with us internally. You got your external credit history, which is your FICO score, that's your credit bureau report. But internally, we're also tracking and we're saying, okay, well, this person had a $10,000 operating loan and they successfully paid it to zero every year. We've renewed it. We've had no problems. You've built up a good internal credit history too. It's going to make it easier when it comes time to take a loan to buy a farm. Non-farm income is a strength. Sometimes people will say, well, you know, it looks like I want to take a farm loan, but it's going to take a couple of years to establish our enterprises there. And so it doesn't look like we're going to make a lot of money on the farm, at least initially. Is that going to look bad? Well, as long as you've got non-farm income, that offsets any weakness that you might have on the farm side. So non-farm income is definitely a strength. All right, so that's all I'm going to talk about with farm lending. I'm going to move on from there unless there's any questions.
So when you're doing your assets,
Yeah.
obviously it's always banker to fill it out because you can do whatever you want. You can write a huge number on there, but the lender has to approve of that, or do you guys going on the schedules behind and change that to what it really should be?
Yeah, that's a good question. So the question is, a farmer filling out a balance sheet could put any numbers down as asset values, right? We are going to look at it and we're going to say, yeah, these numbers are reasonable. We generally take the farmer's word for it. You know, if you got a tractor and you say it's worth $20,000, I'm not going to say, well, I think that tractor is worth $18,000, Ron. You know, no, I'm going to change that. No, we're going to generally take your number, but if it's way out of line, we will make adjustments. You know, and we probably see that most on breeding livestock. If breeding livestock is really hard. I mean, 2 or 3 years ago, a dairy cow was worth $1,300. Now she's worth $2,500. You know, and so do you change that every single time you put together a balance sheet? I tend to, and most farmers actually tend to be on the conservative side, and they'll say, yeah, the market's 2,500, but I don't want to put 2,500. I want to put 2,000 or 1,800. You know, if we have to liquidate, we're probably not going to get top of the market. So we want to be cautious with the numbers. I don't like to see farmers go too much that direction because then it can make it really hard. Like if they say, well, I'm going to put my cows down at $1,000. Okay, well, now I can't loan you any money because the cows are not worth $1,000. They're worth $2,000. We want it to be a reasonable number.
I'm sure you've dealt with somebody that's been way off one of the loans bad, and made it look really good.
Yeah, I don't see when I see a mistake on the balance sheet, it isn't so much on the asset side, it's the liability side. I had that this week. I got a balance sheet from him, and he's talking to him on the phone. He said, oh, my credit score is like a 740. You know, they have really good non-farm income. I pulled their credit report. He had $375,000 of debt on his credit bureau report that didn't show up on his balance sheet. $375,000. Yeah, and it's like, we're gonna check this. You know, I mean, that's
what I'm
yeah. The asset side isn't as easy to check, but on the other side, we've got a whole list. You know, and it tells us to the penny, and it tells us what your monthly payments are and all that stuff. So. His credit score was 740, like he said it was, but he just forgot a lot of debt.
You got that little detail.
Yeah. Yeah, it happens. All right. So from here on out, I want to refer to an example farm. I think sometimes we start getting into these numbers. It's a little too abstract if we just talk about balance sheet or P&L, and you don't have a farm in mind. So Here's our example farmer. His name's Angus Stocker. He's a 25-year-old. He started a stocker grazing business 2 years ago. He's renting his pasture right now. It's 40 acres of pasture. He's running 35 steers on that 40-acre pasture. He's selling finished beef, $2,500 a head. His gross farm income in a year's time is $87,500. He'd like to buy land. So he's thinking about buying land at some point. He really would like to own his own place. At this point, he doesn't own anything. He has an off-farm job, and it's an okay off-farm job. It's covering all of his family living costs. He's got a pickup truck. He's got some payments on that. His off-farm job is covering those payments. He doesn't have a lot of extra from his non-farm income, though. So that's kind of his situation. He's trying to build up his farm side, but he also has decent off-farm income, too. So first is the balance sheet. Excuse me. And again, on the balance sheet, we've got assets and liabilities. Assets, that's everything that's owned by or payable to the farm on the day you put your balance sheet together. Liabilities, that's all the obligations owed by the farm on the day you put your balance sheet together. We just take the assets minus liabilities. It gives us the owner's equity or the net worth position. So those are the three things that show up on a balance sheet. It's important to note, too, that a balance sheet is a point-in-time statement. So if you put it together today, it's whatever those numbers are today. They could change tomorrow. They were different yesterday. It's just what they are today. It doesn't include income or anything. It's strictly assets and liabilities on a particular day. Yes, Annie?
So if you do one every January and I come to you for one in June, do I have to update my balance sheet for you, or would you take the January one?
Yeah.
You want it updated.
Yeah, that's a good question. We do like to see them updated. And 90 days is typically, we want it within the past 90 days. It's a great idea to get in the habit of doing it on January 1st every year. Businesses outside of agriculture have to do it because they file a Schedule C. They have to show changes in inventory. That affects their tax liability. In agriculture, because we typically use cash accounting, we don't have to do a balance sheet every year. But it is important because, and I'll talk about that here in I think it's the next screen actually, why it's important to do that balance sheet every year. It's going to show you the progress you're making in your business over time. So it goes beyond just lending. It's a good business practice. Yeah, what's so great about a balance sheet? Well, it's used to calculate important measures of liquidity and solvency, and we'll show you two measures of liquidity and solvency for Angus here in a minute. It's going to show you financial progress even if cash flow seems tight. And especially when you're just getting started in a business, especially a business like yours, Cindy, where you buy breeding livestock and you build fence and you got a lot of cash going out for a year or 2 or 3 years. You don't have any cash coming back in. And it can start feeling like, what are we doing this for? We're just shoveling money out the door every day and we're working our tails off. And at the end of the year, we had $1,000 in the checking account, which is exactly what we started with at the beginning of the year. Well, if you're doing a balance sheet, you're showing over the course of the year, you've built up breeding livestock. You have young stock that you didn't have at the beginning of the year. You got feed on hand that you didn't have. You got improvements on the farm that you didn't have. So you've built up a bunch of assets, even though it didn't turn into cash. You built up assets. You made progress. You did good stuff in your business, but it'll show up on the balance sheet, not in your tax return.
You did that for exactly that reason.
Yeah.
Because it's like, oh my God, where this money just keeps going out. It's like, well, wait a minute. When I did the balance sheet back in January, I also got something.
Yeah.
You could see, okay, we're worth this much money. That's really, we're doing good.
Yeah, you can feel better about, you can see the progress. You can see the results of your hard work. Yeah, that's really important. It's going to help us figure out how much cash we might have to invest in something. And I'll show you how we calculate that number. And then if you're doing it on January 1 or December 31 every year, it's going to align with your federal tax return. And that's going to make analysis really easy. You'll be able to calculate 21 ratios of the financial performance of your farm business. So, all right, these numbers get pretty small. This is Angus's balance sheet. Folks in the room here have a handout that shows these numbers in a little bit closer detail. But, he's just getting started. So he doesn't have a lot on his balance sheet. He's got cash and checking of $9,400. Most of his balance sheet is made up of his market livestock. And the value when he puts the balance sheet together they were at $66,000. So he's got 75,400 of current assets. Intermediate assets, he's got a little bit of equipment, he's got his pickup truck. That's pretty much it. He doesn't own any real estate, so there's nothing down here in the long-term asset category. So his total assets are $108,400 down here on the bottom. Excuse me. On the liability side, he's got $1,000 account payable. So that's probably for feed or something. He's got an operating loan. So he took an operating loan to buy his stockers. He owes that operating loan and it's due within a year's time. So the liability there is $39,400. And then he's got some principal that's going to come due within the next year on his pickup truck loan, and that's $6,007. So that shows up as a current liability as well. So his total current liabilities are 46. I think that's 46. Is it 46? Yeah.
46.
407. Yeah. Okay, and then his longer term balance on the pickup truck loan, he doesn't owe too much more on it. That's 3148. So his total liabilities down here on the bottom line, 48,556. And his equity position, we take the assets minus liabilities, is 58,000. Is that a 584? 844. Yeah. Numbers are even too small for me to read. So how does that look? Well, we'll calculate his liquidity first. So one of the most important liquidity factors that we look at is the working capital. Working capital is a dollar amount. We take the current assets minus current liabilities. So he had current assets of 75.4, current liabilities of 46,407. His working capital is 28,993. So out of context, we don't know if that's good or not. Is 28,993 working capital good or is it not good? Well, we look at it in relation to his annual gross farm income. We said his annual gross farm income is 87.5. His working capital, when we take that 28,993 divided by 87.5, it's 33%. Our target there is 15% or higher. So he's actually got a strong working capital position. We would be happy to see that, you know. So that's pretty good. Target's 15% or higher, he's at 33%. But another measure that we look at, when we look at this category of current assets, the $75,400, we want 10 to 15% of that in cash. You know, you can hold your current assets in a lot of different forms. You could prepay expenses. You could build up your market livestock like he has. There's a lot of different ways to hold your working capital or your current assets, I should say. But we want about 10 to 15% of that in actual cash. His is 12.5%. So we take that 9,400 of cash, divide it by the 75.4, that equals 12.5%. So he's right where we'd want to see with cash. He doesn't have excess cash, but he's not short of cash either. He's right where we'd want him to be. And then solvency, we look at the overall balance sheet for solvency. So we're saying, are you solvent or are you insolvent? If you could sell all of your assets, pay off all of your debts, and walk away with something, you're solvent. If it's the other direction, you sell your assets and you still owe something after paying all your debts, then you're insolvent. Well, there's three different ways of looking at this. I only ran one of the calculations, and that's the equity to asset ratio. So we're looking at this equity position, his net equity position, dividing it by the assets. He's at 54%. The target there is to get to 50% or higher long term. You know, and most farmers want to get to 100%, where you have no debt at all. You have 100% equity to asset ratio. If he borrows money to buy land, it's going to drive the equity to asset ratio down. It always does, especially with a beginning farmer that's starting with a relatively thin balance sheet. So he's in a good position now, but we're cognizant of the fact that if he buys land and takes on debt to buy that land, he's going to end up driving his equity to asset ratio down. Okay, now we're going to consider his P&L and his cash flow, and then look at what his taxes might look like. So his P&L here, we're looking at his revenue, and his only revenue source is selling his steers. So that's 87.5. So his expected revenue in a year's time, 87.5. His expenses, he's got to buy some feeder cattle. He's got some car and truck expenses. He's got some chemicals, a little bit custom hire, some feed. when they're not out on pasture. And then he's got an estimated cost of interest on his operating loan right here. And what else? He's got his land rent, $2,400 right here. And he's got some repairs and maintenance expenses, just $300. Got some other utilities, vet expenses. So his total expenses, $70,600. So he's expecting his net income to be 16.8 on the farm side. So, which isn't too bad. And then on the non-farm side, he's got his job. He's earning $45,000 a year at his job. We add up all of his family living expenses, and he's single. So he's paying rent on an apartment, and he's got some other expenses. Total expenses, $42,500. So he's going to net about $2,500 on the non-farm side. So that's kind of what his P&L looks like. So the thing about a P&L, this is an estimate for the entire year. And we know in agriculture, we don't get our income in January and then pay all the expenses the rest of the year, right? We pay all these expenses all year long, and we hope we bring in some income along the way too. That's why it's important to run a cash flow. We want to know what months are the expenses being paid out, what months do we have income coming in, and then what months are we going to be short and have to tap into non-farm sources or tap an operating loan or other things. So we're going to run this out to a cash flow projection. He's starting here with, I think it's 6,200 in his farm checking account, 7,200, excuse me, in the farm checking account. He's selling some steers. This is a typical year. So this isn't necessarily year one. This is, once he's been in business, he's kind of got his cash flow down. So he's starting the year, he's got 7,200 in the checking account. He's selling some steers in the month of January. So that's bringing in 37,300 there. So he's got cash that came in, he's got bills being paid out, he's paying something towards his operating loan, and he's ending the month with $17,200 in his checking account. That begins the next month. He sells some more steers that month, has some bills to pay, pays off the balance of his operating loan, and he ends that month with $24,700 in his farm checking account. He's got no cattle in March, and he doesn't have any expenses in March, so the balance doesn't change here, that 1 month. Then we get into April. He has to pay his rent, so he had to pay that money out. So that came out of his cash balance in his checking account. So now we're down to 22,300. And then we get into May. Well, he's got to start buying steers in May, and he's paying for them. So he's having his operating loan here. That's this cash that came in from loan proceeds. Here's where he's buying the steers. He's got a bunch of expenses that have to be paid. And then we kind of watch the bottom line as we go through the rest of this year to see where he ends up. And so he's ending up at the end of the year, right down here, December 31, he's going to have $9,400 in his checking account. So he went through the whole year, bought steers, paid a bunch of bills, started with $7,400 in the checking account, ended with or $7,200, excuse me, ended with $9,400. So the net cash flow for the entire year is $2,200. That doesn't mean he made $2,200. That's just how his cash balance changed. We get to the end of the year, he's still got steers. So we look at his balance sheet, he's got steers on the balance sheet, but they didn't turn into cash yet. So this is just how the cash flowed through the operation during the year. And then this is what his tax return looks like. I won't go into all the detail. The expenses are all pretty much the same. The only thing I changed on the tax return is he didn't have any depreciation on his P&L, and we did bring in some depreciation. His accountant is going to say, you got the truck, you're using the truck in your business, we're going to take some depreciation, reduce your tax liability. So we get to the bottom line there, and it is $13,900 if I'm reading correctly. Okay. So a couple of points to make about taxes. Okay, so income taxes are progressive. People think about, well, I'm in the 22% tax bracket, so that must mean I'm paying 22% on everything I make. Or I'm in the 24% tax bracket, I must be paying 24%. I don't want to do that, right? Well, that isn't necessarily the way the taxes work. we have a standard deduction. So when you get paid, if you're single, the first $15,000 you make just is taken off the board right away, right? So standard deduction for him is $15,000. If you're a married couple filing jointly, it's $30,000. He makes $45,000 a year. So the first $15,000 that he made is taxed at zero, right? That's his exemption, his personal exemption. There's no tax on that first $15,000. The tax bracket, the 10% tax bracket goes from 0 to 11,925. So anything that he makes over 15,000 up to another 11,925 is going to be taxed at 10%. So 11,925 is taxed at 10%. Then the next chunk that he gets paid goes into the 22% tax bracket. Or excuse me, 12% tax bracket. I'm looking at the wrong line here. So the 12% tax bracket, anything he makes from 11,925 up to 48,475 is taxed at 12%. So he had 11,925 taxed at 10, 18,075 taxed at 12. That's out of his $45,000 of income. The total tax he would pay is $33.61, federal tax. His effective tax rate isn't 12% or 10%, it's 7.5%, right? I think people worry a lot about paying taxes, but when you think about it and it's incremental and you're paying that highest tax rate on the last dollar you made, not on the first dollar you made, I think it can change the way that you think about how you earn money, and especially how you earn money on a farm. A lot of people, their goal is, on your Schedule F, I want 0 at the bottom, or I want a negative number at the bottom, because then I won't have to pay any tax. You're still not going to probably pay very much tax. And in his case, let's see how it worked out. Again, he's a single filer, so I eliminated that second column so we can focus just on this column. This first part is the same as we had on the previous sheet, but he had 13.9 on the bottom line of his Schedule F, right? And that's going to be taxed in the 12% tax bracket. He didn't take himself into the 22% tax bracket, earning $13,900 on his Schedule F. So he's going to pay 12% on that 13.9. He's still in the 12% tax bracket there. His effective tax rate went up to 8.5% because he's paying just a little bit more of his income in the 12% bracket. So people will do a lot of things to avoid paying taxes, buying equipment and buying depreciable assets, taking on debt for assets to keep your taxable liability down when you'd be much better off just paying some taxes. I mean, we're going to charge 7.5% on a loan if you went and bought a piece of equipment. So don't worry about paying an 8.5% tax rate, you know.
You're more on a growth stage going in the business, the things that you will need eventually, is that smart to do? And instead of paying taxes, if you do have profit left over, to make sure you manage that correctly?
Yeah, that's the question is, so if you're in growth mode and you know you're going to need these things at some point, is it better to buy those things? Yeah, and it's all within reason, you know, and it's I get probably the other thing that comes into play here is with agriculture we can accelerate depreciation. You know, we have Section 179, so we can expense 100% of a piece of equipment in the first year. And I see people doing that, like, well, of course, I want to take as much depreciation as I can, and you drive your bottom line on your Schedule F down to like negative $30,000 or something. You weren't going to pay any tax anyway, so you might as well just depreciate it over a longer period of time, especially if you're going to be in business a long time. Yeah. Okay. So that's all I'm going to say about taxes, balance sheets, P&Ls, cash flows. Now we're going to get into the fun part, which is farm investment analysis. So we're going to think about making capital investments on the farm. So how do we decide if we're in a good position to make a capital investment? And what do we mean by capital investment? So when we talk about capital investment, we're talking about using our cash or using the equity on our balance sheet. We can access cash by using our equity on our balance sheet, or taking on debt to purchase intermediate or long-term farm assets. So anything that's got a life of more than a year. So we're looking at machinery, breeding livestock, buildings, improvements, or purchasing land. So in Angus's case, we first have to figure out what financial resources does he have available to invest right now. Well, we looked at his balance sheet before. We said his cash position is really pretty much where we want it to be. So he doesn't have any cash to invest right now, right? He's got He's got the amount of cash we'd want in current assets, but he doesn't have any excess. So he really doesn't have cash to throw into anything. Next, we want to consider his cash flow. Can he afford to make an investment that reduces his farm's cash flow? So we can make investments that add to cash flow, or we can make investments that take away from our cash flow. You know, I've got a W-2 job, right? And when I put money into my retirement account, I'm reducing my cash flow, right? Every dollar that I put into retirement is a dollar that's not available to be used for anything else. So I know I'm setting myself up for negative cash flow if I put money into retirement. But I'm doing that with the expectation down the road I'm going to get a lot more back. It's going to grow over time, and I'm going to get a stream of income when I retire. Well, we can think about a farm investment the same way. You can make an investment that has negative cash flow with the hope of a reward down the road, or you can make an investment that has positive cash flow now and maybe doesn't have a reward at all down the road. Maybe is worth nothing down the road. But we'll talk about that. So in his situation, we looked, in a typical year, his net cash flow is $2,200. Does he have the ability to make an investment that's going to cost cash flow, that's going to take away from his farm cash flow? He really doesn't. He can't afford to make an investment that would give him negative cash flow. When we think about investment, it forces us to think about how the value of money changes over time. You know, if we get $1 today, we're better off than waiting a year to get that dollar, right? Inflation is going to take away our buying power. $1 today is going to be worth 97 cents a year from now because of inflation, right? So the sooner we get $1, the better off we are. We can stop interest from accruing. We can invest it in something. If we make an investment, though, the benefit of that investment, the expected benefit is down the road someplace. And so we have to adjust for the value of that dollar the longer we have to wait for that dollar to come back to us, right? So the longer we have to wait, the bigger the payment should be farther down the road. We have to adjust for the value of waiting. If you took money and you put it into a 3-year CD right now, and the three-year CD is yielding 3%. We take $10,000, it's going to yield 3%. We can calculate that in 3 years, we're going to have the $10,000 plus 3% interest in year 1, plus the 3% interest in year 2, plus interest on the interest that we earned in year 1. And then in year 3, we're going to have the interest in year 3 plus the interest, a return on the interest in years 1 and 2, right? And we can calculate that out, and it's going to be worth $10,927 3 years from now. If we make that $10,000 investment, it's 3% compounded over 3 years. 3 years from now, it's going to be worth $10,927. So that's called compounding, and we're applying a 3% compound interest rate. We can do the same thing going the other direction, though. So let's say we can make an investment that we know 3 years from now is going to give us $10,000, and we want to earn 3% on our money. We can discount back to today's dollars to figure out how much money do I have to put into the investment right now if I want to get 3%, and in 3 years I'm going to get $10,000. We have to discount by $849, it's $91.51. So we know if we put $91.51 in here, we want 3% on our money, that'll give us that $10,000 3 years from now. So we're discounting from the future back to today's dollars. And then we're applying a 3% discount rate. So why is discounting important when we talk about making farm investments? Well, if you make a farm investment, you look at buying a piece of land, piece of equipment, putting up a hoop house or whatever it is, we don't know what the return is going to be on that. You know, if we go into a bank, they're going to tell us what the return is on the CD, what the compound interest rate is on the CD, but we don't know what it's going to be on a farm investment. We can, however, probably figure out how much cash we have available to invest. We did that with Angus. He doesn't really have any cash available, but a lot of people do. We can estimate how that investment is going to impact annual cash flow, whether it's positive or negative over a period of time. So we've got that number that we can figure out. We may be able to figure out what that investment is going to be worth at some point in the future. We just have to decide what rate of return we want on our investments. We have to choose what is an acceptable discount rate to us. And it might be 5%, or it might be 8%, or it might be 15%. But we have to establish a discount rate. The simplest way to do that is you could use the interest rate you have to pay to get a loan for the investment. So right now, if you bought a piece of equipment, it's probably going to be 7.5%. If you bought a farm, it's going to be probably 7.5%, 8%. So you might say, okay, well, that's the discount rate. If I'm going to look at an investment, I want to get at least 7.5 or 8% on my return on my investment. You could use the prime lending rate and add to it the rate of inflation. That's going to give you about 10% right now as a discount rate. You could establish a personal hurdle rate, and you can say, well, I'm not making an investment in anything unless I can get a 15% internal rate of return on my money. And that's a pretty typical number. A lot of venture capitalists, 15% is just sort of a standard number. Whatever method we use, we have to adjust for the riskiness of the investment. So if we're not quite sure that the cash flow is going to be what we're projecting, we're going to bump that discount rate up. We're going to expect a higher discount rate to adjust for the risk of that investment. This whole discussion, this is net present value. So net present value is that discount, so it's looking at what's a future cash payment worth in today's dollars at a given discount rate. So you can do it for one single payment, but you can also convert a whole stream of future cash flows into one single number today and say, okay, I can put this much in and I'm going to get whatever the discount rate is that you want. It's going to tell us if an opportunity is a good investment, whether it meets our hurdle rate or doesn't meet our hurdle rate. It's not going to tell us if it's our best investment in dollars. So it's not going to say, okay, well, I could invest in beef cows or I can invest in a rental property in town. Which one of those is going to give me a better rate of return? It's just going to say, does this one give me my hurdle rate or does this one? So we're going to go through just a really simple example to show how this works. So let's say Angus wants to buy a log splitter and it's going to cost him $1,500. So he knows what the cash investment is going to be up front. It's going to be $1,500. He does a little cash flow projection. So he figures out how much the fuel is going to cost, how much it's going to cost to maintain this piece of equipment. He figures he can get an extra $200 worth of firewood each year using the splitter versus what he would have gotten by splitting wood by hand. So there's $200 of cash flow that he's going to get in a year. He can also rent the splitter to a neighbor for a couple of days each year, and the neighbor's going to give him $100. So his total annual cash flow is going to be a positive $300. He's going to use that splitter for 5 seasons, and at the end of the 5th season, he's going to sell it for $1,000. So what kind of return did he get on this investment? It's tempting to do this calculation up here. So you'd say, okay, well, his net cash flow each year is $300. He's going to own it for 5 years. So that's $1,500. He's going to get $1,000 when he sells that thing at the end of 5 years. So $2,500 of cash coming in. His cash going out was the initial purchase, the $1,500. So his net cash flow for owning it for 5 years is $1,000. Right? So it's that 2,500 minus his initial 1,500, net cash flow of 1,000. That suggests you get a 67% return on his money, right? Because it's $1,000 of cash flow over 5 years divided by the 1,500 he paid for it initially. But it's not true. He didn't get all that cash flow at once. He didn't buy it today, get all that cash flow, sell it tomorrow, right? It took 5 years to get this cash flow. So we have to discount that whole stream of cash flow for 5 years to figure out what sort of a rate of return is he getting on this investment. So we're going to apply a 5% discount rate and test this to see how it works. So year one, he had to wait an entire year. He buys the log splitter. A year from now, he's gotten $300. The discount factor that we apply, and you can get these from tables, but I'll show you in a minute. We use spreadsheets now. This was, when I learned how to do this back in college, we had to do it by hand. We had to keep running these numbers out by hand. But if we take that cash flow, because he had to wait a whole year, in today's dollars, it's only worth $286 to him, right? The second year's cash flow, another $300, but he had to wait 2 years to get that cash flow. So discounting it back to today's dollars, it's worth $272. And then in year 3, he had to wait 3 years. That's only worth $259 in today's dollars. In year 4, that's worth $247. And then year 5, this is the year that he's selling it. So he gets $300 of cash flow from the firewood and from renting it to the neighbor. And then he gets his $1,000 for salvage value, but he has to wait 5 years to get that money. We have to discount it back to today's dollars over 5 years. That's worth $1,019. So that cash flow is not worth $1,300. It's only $1,019 in today's dollars. We just add up that column, that present value of the annual net cash flow. The net present value of that stream of cash flow in today's dollars is $2,083. What that's telling us is he's getting better than a 5% rate of return on this investment. If he was getting a 5% rate of return, this would be $1,500. It would be exactly equal to what he paid for it. So we know the initial cash outlay was $1,500. The net present value of the cash flows was $2,083. So it's definitely better than a 5% rate of return. We learned before it's less than 67% because 67% didn't take into account the fact that we had to wait 5 years to get the cash flow. So it's somewhere between 5% and 67%. Back in the old days, we would just keep plugging in. Like I'd put in discount factor, the discount factor's at 10%, and then run all these numbers out. And you get kind of close. Now we can plug it into a spreadsheet. This whole exercise is called internal rate of return. It's just a way of checking different discount rates until we get to the one where the net present value of the cash flow is exactly equal to what our initial cash investment is. It's going to tell us what the annual rate of return is on our initial cash investment, on that initial $1,500 cash investment that we made. And by doing that, now we can compare different investments that have different time horizons, different cash flow patterns, different cash requirements up front. You know, one might be 1,000, one might be 100,000. And they have different, you know, just different patterns of cash flow. One might be worth nothing at the end, one might be worth double what you paid for it. And so now we can compare these things and figure out how we're going to get the best rate of return on our limited amount of cash that we have to invest. So how good is the investment in the log splitter? Well, here's the $1,500 that we put in right now, year zero. Here's those $300 cash flows that he got for 5 years, and then the $1,000 that he got when he sold that piece of equipment. This is just a spreadsheet that is automatically running those discount factors. We don't have to do it by hand anymore. And it's telling us that his internal rate of return was a little over 15% on this investment. So still a good investment,
Yeah, but
but not 67%.
are you sure he's gonna get $1,000 for it?
We don't know. Yeah, right.
He's dreaming.
Yeah.
There's the value on the time it's gonna save you cutting that wood.
Well, that was all.
Doesn't your price maybe go up a little bit instead of $300 a year for 5 years? Maybe firewood is more expensive than a couple of years.
Right. Yeah, and you both are making good points,
Yeah.
and that's
I know,
Yeah.
I agree. But
yeah. And his time was factored into that $300. So he's saying he was splitting logs by hand. He can get $200 more firewood, or maybe it's a lot more than that, but he's subtracting off the cost of maintaining. And he could build in an inflation factor. He could change that number and say, okay, well, it's 300 year one, but it might be 350 in year two, or 375 year three. He could plug in $800 at the end of 5 years instead. You know, it's just, I'm just showing you how the math works and how you can calculate this, and then you can fine tune it from there.
Also an asset. Is it all?
Yeah.
I would say now you can buy a new one. I just keep the thing.
Right. Yeah.
By now, it's gonna be 2,500 to buy a.
Right, and that's
Right. Yeah.
Lots of different ways to look at things.
There's a lot of different ways to look at it, and he doesn't necessarily have to sell it. He might just have this on his balance sheet as $1,000 5 years from now, and he's gotten a 15% rate of return. So, was it a good use of his 1,500? That's really the main question. If he had 1,500 and he could invest it in one beef cow, or he could invest it in this log splitter, or he could invest it in a new pickup truck, or whatever. You know, I mean, you can run it a lot of different ways and figure out, well, which one's going to give you the best internal rate of return.
You know, remember he's 5 years older. As they get older, we don't spend as much work with them all.
Yeah, and that's actually another really good point. So I guess I didn't mention up front, I co-authored a book called Fearless Farm Finances. And we cover all of this stuff, balance sheets and cash flows and profit and loss. And I wrote the chapter on investment analysis. And one of the other guys, as we were working on the book, and we were sending the chapters to each other, he sent it back and he said, but there are things that I would still invest in, even if the internal rate of return is not good. And that's an important point because we do get old. And so, yeah, I used to split wood by hand, and I bought a log splitter, and I didn't like the idea of buying it. You know, it felt like I should be able to split wood by hand. You know, I'm not a baby, you know, but I'm tired at the end of the day too. And it's, so yeah, it could be a good investment, even if the internal rate of return.
It's the same with looking at a air conditioning heated tractor cab compared to an open station tractor.
Right. Yeah. Yeah. It doesn't all come down to dollars and cents. Yeah. It hurts me to say that as a banker, by the way. But no, it doesn't all, yeah, it doesn't all come down to dollars and cents. So what does all this have to do with farming? Well, we can calculate the internal rate of return on any investment if we know just these three things. The initial cash investment that's required, the estimated annual cash flow while we own it, and we can run those cash flows any way it makes sense to do it. And then the remaining value of the investment at a given point in its lifespan. Whether it's 5 years, 10 years, 15 years, 20 years, it could be anything. So what about making a big investment? Like he was talking about buying land. He wants to buy the land that he's been renting. So he's been renting that 40 acres of pasture. He's been paying $2,400 a year for that. The landowner comes to him and says, I'm willing to sell this land to you for $200,000. So $5,000 an acre. He does a cash flow projection. He's going to have to borrow money to buy this land. He doesn't have $200,000, right? So he's going to have to borrow money. He figures his cash flow is going to be worse by $14,600. So he makes this investment. Now he's making mortgage payments. He's paying property taxes. So it's taking away from his cash flow, right? And the cash demand each year is going to be $17,000, but he's going to save $2,400 in rent. He's not paying that rent anymore. He's still going to have the use of the land, right? So his cash demand is 17 minus the 2,400 he's saving. So it's a net of a negative 14,600. On the positive side, though, he's going to build equity. He's going to pay the loan down, right? He's going to be building equity as he pays the principal down on the loan. He's expecting the land's going to continue to increase in value by about 4% each year, which is, by the way, what land increases over the long run. We've had some years when it's been double digits, but it's not always that way. Over the long run, it's about 4%. So he figures he can bank on that at least increasing by 4%. He really wants to buy this land. He just really wants to own it, right? But is it a good investment? Well, some of the things we have to consider. Number one, he needs to put down 10%. So that's $20,000. And then he's going to finance $180,000. And I calculated this at 7.5% on a 30-year fixed rate. We don't know where he's coming up with this 10%. Maybe going to his parents and they're going to give it to him or whatever. So I'm not worried about that at the moment. But he's going to have to make the mortgage payments on his own. That's $15,200. And he's going to have to pay the property taxes. That's $1,800. So that's where that $17,000 a year came from. He's going to save $2,400 though, because he's not paying the rent anymore. The farm, if it increases in value at 4% a year, each year, 5 years from now, it's going to be worth $243,000. And his mortgage balance, which started at $180,000, is going to be paid down to $170,000. So he's built up some equity there too, right? So his equity in 5 years will be that $243,000 minus the $170,000, right? So that's $73,000. But we also have to subtract off contingent liabilities. If he sold this farm, he's not going to walk away with $243,000. He's going to pay transfer taxes, he's going to pay title insurance. He may pay a realtor for commission or whatever. So we're going to take 7% off of his $73,000. And we're going to say his true owner's equity is $56,000 at the end of 5 years. And here's what it looks like. So here's the $20,000 he put down as the down payment. Here's the negative cash flow for 5 years, negative 14,600. There's the equity that he's going to have at the end of year 5. His internal rate of return on this investment is a negative 19.73%. So not a great investment, even if it's going up at 4% a year, even though he's paying his principal down. Well, what if he had the ability to pay cash? His grandfather dies, gives him $200,000 in his will. So he goes and uses that $200,000, buys the land. Now his annual net cash flow is positive because the only thing he's paying is the property taxes. He's saving $2,400 in rent, paying $1,800 in property taxes. So he's getting a net positive cash flow of $600 a year. The value of the farm is still going to go up at 4% each year, right? So, and we take off the contingent liability. He's going to walk away with $226 if he sold it. The internal rate of return there is 2.76%. So
that's after 5 years.
It's after 5 years. This is an annualized rate of return. So it's saying that he would have gotten that rate of return each year. And you can kind of see what happens. So this isn't a good investment, even if you're paid cash for it, right? Because it's lower than the cost of borrowed money, right? And because it's lower than the cost of borrowed money, when he leveraged it, when he borrowed 180,000 to buy it, it drove the return way down. It drove it negative by almost 20%, right? And that's very typical. You know, if the internal rate of return on this was 10% and he borrowed money, it would drive the return up. It magnifies it either direction when you take leverage on it.
But if you was to invest this 200,000, yeah, you could probably get 2.76 back, right? But
Yeah. Yeah, if he took the 200,000, right now he could put it in a preferred savings account and earn over 4%.
right.
He could have taken the 200,000 and bought a rental property in town and run the numbers, and maybe that was a 10% or 12% or whatever. And there you have to, and I own some rental properties, so I tell you that you have to, the discount factor goes up because it's no fun, right? The farm would be fun. Rental property is no fun. You have to increase your discount rates, you know. Yeah. Yeah, and there's,
It's a long-term value.
right, and and if this had a house on it or something, it changes the equation because he's got to live someplace. And so, and if he came to me and he had his cash flow worked and he wanted to buy this farm, even though I'm running these numbers and I'm saying, it's not a good investment, I'm probably going to finance it for him, you know, as long as he had the cash flow for it. So it's not cut and dry, but it's an important thing to think about because we all have just a limited amount of cash to invest in anything. And especially someone who's just getting started farming, they have to make smart investments with their cash. They can't afford to take an investment like this. It's going to have them on a hamster wheel for the next 40 years, right? So, well, what else could he do? Well, let's say instead of buying the land, he rented another 40 acres. That 40 acres needs some fence and needs some other improvements. He has to put in a watering system, that sort of stuff. It's going to cost him $15,000 to make the improvements on that 40 acres in order to make it usable as pasture. So he's going to have to put that money in. He's going to rent it for $40 an acre for 5 years. Now he can run another 35 head of cattle on this second piece of land that he's renting. And we put together a conservative net cash flow. And after paying rent, he can net $200 per head per year. So that's $7,000. And at the end of 5 years, he's going to walk away with nothing. You put that $15,000 in, you use the pasture for 5 years. He walks away, he doesn't get the $15,000 back, right? Does this make any sense? Well, here's the $15,000. There's this 5 years of $7,000 a year cash flow. The internal rate of return on this investment in fence is 37%.
Trying to not lend money for buying land or what?
What's that?
Are you just trying to not lend money for buying land or what?
Yeah.
No,
Yeah.
like I told you earlier, the land that we bought, I guarantee you I'd have made more money the rest of my life. But it was right there. We worked it for 20 some years, no children already. But one thing that I always say, sentimental value is great, but it doesn't pay the bills.
Mm-hmm.
That's what this here comes into. You know, if he's done the initial losing what 20% annually, sentimental value will kill you.
Yeah, and you're making an important point, Ron. And so the point for those of you on tuning in at home, it's you don't always buy land because of these numbers, right? And if it's a 40 that's coming up for sale and it's right next to you, and you farmed it for 20 years and you've put a lot into building the soil and that sort of thing, it's really hard to let someone else come in and buy that out from under you. Especially if you know, like in your case, you have a next generation who may want to join the farm operation. And for them to join the farm operation, it's going to have to get bigger, and land to rent may not be available. It's easy for me to say, just go rent another 40 and put some fence on it, away you go. But it's not that easy to find. But it also comes down to cash flow. You're later in your career than this guy who's just getting started and is antsy to buy some land, but he's not in a position to buy that land. You know, if you own land, you own some that's free and clear, you own some that's got some debt, but not a whole lot, and it's really increased in value, you can withstand negative cash flow a lot easier, at least on that chunk of land, because you're making cash flow on everything else, you know. He's not in that position. And that's where, it isn't that I'm trying to talk people out of doing what they want to do or pursuing their dreams. But, in self-serving, I want to make as many loans on land as I can.
Do this
But
a few times, you now have money to buy.
exactly. That's the point. Yeah. I'd rather make this guy his land loan 5 years from now when he's built up some reserves and he's in a much better position. His cash flow is better. Maybe his non-farm income is better. Maybe he's netting more off of his steers. You know, I mean, you'll be in a much better position. I don't want to set him up to be on that hamster wheel. You know, that I hate to see people do that, you know. So I want to run this just a little bit farther. What if he gets cost sharing on the fence? So he gets equipped, and now he only has to put 4,500 in instead of 15,000, and it drives up his rate of return to 154%. That's the kind of investment I want to make, 154%. You know, yeah, yeah, especially now. Yeah.
Back up one though, where you say he walks away with nothing. My guess is he's got a pretty good relationship with the landowner. And
Right.
he's not gonna walk away from this. Right? Ideally, he can keep renting it.
Mm-hmm. Yeah, and continue to generate that 7,000 a year. We could run this out for 10 years or 15 years. And that internal rate of return is just going to get better and better and better because you've gotten that much farther out from your initial cash investment and generated more cash from it.
Landowner, get that relationship, that's a number you can't write on there,
Mm-hmm.
but it's worth a lot.
Right. Yeah, and a lot of times someone might go to the landowner and say, well, it's going to cost 15,000 to do these improvements. You've got 40 acres here that you're not able to generate any revenue from. I'm willing to rent it as pasture and pay you $40 an acre per year. It's going to reduce your property taxes too, by the way, because, you know, with use value assessment, pasture is your lowest use value. So drive your property taxes down. What if I put the labor in, that's 7,500, and you put the materials in, that's 7,500. So now this is a $7,500 investment instead of a $15,000 investment, you know. Or I put the 15,000 in, but if we end this lease at the end of 5 years, you give me $7,500 to pay me for the materials or something, you know. There's a lot of different ways to run this out. But even just at first blush, worst case scenario, it could be a 37% return. So that's internal rate of return. This is, if you're going to build wealth over a period of time, the way to do it is by beating the rate of inflation with your investments and beating the interest rate that you pay on making investments. That's how you build wealth. If you do it the other way, you're always going to be behind the eight ball. You're never going to build out.
Can you run that on like breeding livestock too? Do you use that?
Oh,
to
sure.
look at the breeding livestock?
Yeah, you can use this for a lot of different purposes. You could say, okay, well, it's going to cost us X number of dollars to buy a breeding herd here. And we know that the first couple of years, we're going to get no cash flow, or the cash flow is going to be negative because we're paying for feed and vet expenses and a lot of other things. But then in year 3, 4, 5, 6, now we're generating positive cash flow. Yeah, I do this for apple orchards, and I've done it for solar projects, and I've done it for timber stand improvements. And I mean, we can run this for a lot of different types of enterprises. Yeah, it's a really powerful tool, and it's something that we don't use very much in agriculture. You know, it's very common in businesses outside of ag, but not very common in ag.
Are these spreadsheets available somewhere?
Yeah, I'm happy to share these spreadsheets. Yeah, any of the stuff that I showed today, the slide deck, any of the spreadsheets in the slide deck, yeah, they're all Excel files. So yeah, I'm glad to share them. So just got a couple other points I want to make. So this is an interesting theory, right? But who actually makes any decisions like this? Who's going to make an investment in real estate that you don't own? You know, it just kind of goes against our grain to do it. Well, these guys do it all the time. Walgreens owns almost none of their stores. All of their stores are leased. And why is that? Because they could, if they own the stores, they could generate maybe a 6 or 7% rate of return on their investment in the bricks and mortar. They don't want to do that. They put their money inside the store. They buy the fixtures. They buy all of the inventory. And that inventory is turning over multiple times a year at 20, 30% profit margins. So they've got limited amount of cash too. They're going to put their cash inside the store where it's generating huge internal rates of return, as opposed to putting it in real estate that gives them 6-7%. And a lot of businesses outside of agriculture do that. They just look at it differently. So a few final thoughts on this section. It takes time to understand this internal rate of return calculation and then to feel confident in your ability to run these numbers. I mean, I've been doing this for 40 years, and so I'm very comfortable running these numbers, but it takes a while to kind of get that concept, that discount, figuring out the discount rates and discounting cash flows back to today's dollars. And what does that actually mean when we're discounting whole stream of cash flow to today's dollars? So it takes time to trust your ability to do it. If you make a capital investment on rented land, the investment has to be under your control long enough to get the cash flow out of it. So if this guy did that in $15,000 of fencing on the neighbor's land, and 2 years from now the neighbor says, "I don't like having your livestock here. They got out on the road one night, and I got the sheriff coming in my driveway, and so no, we're done after 2 years." His internal rate of return would have been terrible if he walked away with nothing on that $15,000. He had to have it under his control and get the cash flow over that period of time. Debt magnifies the internal rate of return positively if the interest rate is lower than the internal rate of return, and it goes the other way too. It'll make, we saw that example, it drove the return way down when he took the leverage on that land. This is the point you made earlier, Ron. There can be good reasons to make a capital investment, even if the net present value or internal rate of return calculation doesn't support it. There are other things, you may not even be in the business that you want to be in if you don't make these capital investments that allow you to be in the business. And then don't let tax avoidance drive your farm investment decisions. And that was what I was trying to get across with showing those tax examples, because I think people worry a little bit too much about taxes when they really should be thinking more about this sort of thing. What investments make the most sense for us to make on this farm if we're going to be here long term? So that's what I've got. And there's my contact information. You can probably tell I love doing internal rate of return. So if this intrigued you and you want to run some scenarios, I'm more than happy to help you with it. If you want any of the spreadsheets, send me an email, give me a call. But we'll open up for questions, I guess.
Back up one slide. I'll ask you a question or give you a comment. So you said there can be good reasons to make capital investment. Just dividing pasture, you've been out to the box out there.
Yeah.
You can make a lot more money sticking a little more investment in. We don't show that, and you should have been 7,000 a year or whatever you were showing there.
Mm-hmm.
But if you can double or even triple your herd, that's worth doing.
Oh yeah.
And Angus has got a job that's not there all the time. It's a little bit different.
Mm-hmm.
But there's a lot of times it's good reason to do that.
Yeah.
Capital investment, even if you don't have the whole years. I mean, it doesn't take long to make the money back if you're tripling your capacity.
Right. Yeah, and so that's the point that Ron's making is, do you mind if I share the scenario? So Ron's renting a pretty sizable pasture acreage, 53 acres, and it's not really subdivided at this point. You are rotationally grazing it.
Now?
Yeah. Yeah.
But it wasn't when we started.
Okay.
The guy who was renting before said 40 head, 40 head of spring head.
Okay.
And in a few short years, we divided the hell out of it, and last year we had 154.
Okay.
So that changed, and that's exactly what I'm talking about. It is worth dividing the pasture on your own.
Yeah, that's a really important point. So the carrying capacity of that pasture was 40 head. The guy who was renting it before you that was just set stock grazing it.
A little bit. It was rotated, but
Not intensively.
Right.
Yeah. And you've subdivided it, and now your carrying capacity is
154 last year.
154 head. So you put some investment.
Oh yeah.
Yeah.
But that's what I'm getting at is it's worth doing that. Like
That little bit of investment.
that little bit of investment that you don't have. You were just year to year. I didn't know where we were at.
Yeah.
But boy, if you're there full time and can stick that extra capital in there, it makes a big difference.
Yeah, and if you think about if you had to go and try to find that much more pasture to take on another 110 head, yeah, versus just making the improvements on the pasture you already have under your control. As long as you've got it under your control long enough to get your investment back, but it probably didn't take long. If you ran the numbers,
That's what I'm saying, is
yeah,
if you can do something like that, it doesn't take very long.
yeah,
But before I talked about the relationship, working with, and that's a great scenario out there. One year we didn't talk in the fall, but next year, got out there, started talking, and said, he goes, you still want the pasture? I said, yeah, I maybe had a small heart attack in between there. He goes, good, somebody stopped to ask, and I said, oh my God. He said, I told him it was Ron's as long as Ron wanted it. That's that relationship. You get,
yeah.
like I said, that 5 years where you had up there, you get a relationship built with somebody.
Mhm. Oh, yeah.
I had a question on the, balance sheet. On the asset column, in your example, there was nothing for real estate for, like a house or land. So basically, like, if you've got I guess we've got land with our mortgage, for the primary mortgage.
Yeah.
Would you put that on the asset column or only what we have in equity right now?
No, I put it in the asset column. So the question was about the balance sheet. And that example was for this guy who didn't own any real estate.
Yeah.
But yeah, if you own real estate, it should go in on the asset side, whatever the current market value is.
Okay, so it's just current market value. It doesn't
Yeah.
matter what you owe or what you have is equity.
Right. Yeah, it should be at full market value on the asset side, and then whatever you owe is on the liability side. Yeah.
So would it make sense to do an IRR kind of calculation that's kind of proportional to the time frame of, like, you've got the current, intermediate, and long-term assets?
Yeah, it's not really, it doesn't really matter a lot. You know, it's more the time frame that you think you'll have that investment in place. Yeah, so like if I run these scenarios for an apple orchard, for example, you know, I may run it out for 10, 12 years, you know, as long as they think the apples will be still pretty productive, you know, before they start to tail off in production. Yeah, we can do it. I've done this for organic transition, you know, if you're buying some equipment and transitioning land to organic production, you know, running out. A lot of times the cash flow is negative for the transition years, and then it turns positive. And then it goes up and down because you know, have a year of corn when it's generally pretty profitable, and then the next year might be small grains and it's not that profitable, you know.
So the advantage of doing an operating loan as a young farmer or newer farmer, if it's really just to build, you said commercial
Commercial credit.
Commercial credit. How important is that?
Yeah, it's, excuse me.
I mean, I could pay off a couple of small, you know, loans that were just through a regular bank and get an operating loan. Would there really be an advantage to me?
Not necessarily, yeah. So the question is, you know, I mentioned increasing your likelihood of being able to get a loan, to be approved for a loan. And one of the things was taking a small operating loan. If you don't intend to really take more credit down the road, there's really not much of an advantage. A lot of times what we're doing is I work with a lot of first generation farmers. A lot of them are pretty small scale. So they'll start off and they're paying stuff out of pocket. And then they start putting stuff on credit cards. And then the credit card doesn't get paid off. And they're accruing 26% interest on the credit card. And that's where we're stepping in and saying, no, take an operating loan, pay off the credit cards at 26%, and we'll give you an operating loan at 8%. And you're going to save $3,000 in 2 years in interest on a $5,000 balance. You know, I mean, it's a huge, huge difference. But even somebody who doesn't have credit card debt, if they're young, they're just getting started, and they're saying, okay, well, maybe 3 years from now, maybe 5 years from now, I want to buy some land, or I might want to buy some equipment or something. That's where I'll say, take a small operating loan with us, even if you never touch it. You know, just have it in place, doesn't cost anything to get it set up. If you never use it, you never pay anything on, but if you need it, it's nice to have that cushion. You get hit with a big bill you didn't expect, that you can throw it on the operating loan and only pay 8% for a month or two until you pay it back off, instead of using credit cards and destroying your credit.
Yeah, I pay my credit cards every month.
Yeah, there probably would be no
You never
advantage.
know, you're right. We had to put in a new furnace this month and it's like, whoa, where are we gonna get $10,000?
Yeah,
But that wouldn't be a farm expense either. I wouldn't want to do that
yeah,
on a farm operating loan, but you do get those kind of crazy, all of a sudden you need a lot of cash.
yeah.
What's it down here?
Mm-hmm.
I got a question on the credit. You said you deal with some Amish that have no credit, or so is that like a manual underwriting situation then, or?
Yeah, so the question is if I'm working with an Amish person that has no credit score, just nothing on their credit bureau report. If it's under our microloan, under that emerging markets microloan up to 75,000, we do some manual underwriting, but it's very limited. We have a little underwriting template. I run some cash flow ratios and stuff. I send it to my boss. He's got sole lending authority under that program. So I'll spend 15, 20 minutes doing a write-up. I send it to him. I say, hey, I've got this deal. Could you approve it? He approves it. It's done. It's that simple.
There's character there before it comes out.
Mm-hmm.
And if you have a relationship with that family already, that's gotta go a long way towards ending that, right?
Yeah, that definitely helps. A lot of the folks I work with though are people, they're first generation farmers. So they don't have a family history with us. They don't have a personal history with us. They're just getting started farming. They might only have a year or two of farming experience, or maybe no farming experience. They're just starting out. And we're willing to take a chance, you know. We're relying on, we pull the credit report, we verify the debts on the balance sheet with the credit report. We don't, under the microloan, we don't actually use credit score as part of our underwriting criteria. So we do pull the credit report, but it doesn't really matter what the score is. We're just using it to verify the debts. So it's unusual.
Yeah, that's.
Well, yeah, we created it that way because this is a segment that we're working with, that it's just different, they just have a different profile. We also don't have a maximum loan to value. I didn't talk about that much when I talked about the loans, but if we're making a tractor loan, for example, we may only loan 70% of the value of that tractor. So you buy a $100,000 tractor, we may loan you $70,000 for that $100,000 tractor. Now, if you've been established, you've been farming for a long time, you just say, well, I've got some other equipment that is free and clear. You can take that as collateral too. Now we can give you the $100,000 because we've got $150,000 of collateral. The new tractor at 100 plus another 50 that didn't have any debt against it, right? Well, we'll have somebody come in under our microloan. They need a hoop house, and the hoop house is $15,000. They don't have any other collateral to pledge. All they have is the hoop house, and they don't have cash. If I say, well, I can only loan you 70%, and technically a hoop house is considered specialized collateral. I'm supposed to discount that by 50% right off the bat and then loan 70% of the discounted value. So now we're saying it's worth $7,500 and we're going to loan you $4,500, whatever the number is. And the person say, well, I came to you because I don't have $10,000 to buy a $15,000 hoop house, you know? So under this microloan, we said, we wrote it in that we didn't have a maximum loan to value. We take the best collateral we can get, but we're often undersecured, technically. But we've had great success. We've made over 400 loans in our program. Our portfolio is $40 million. We've never lost a penny, not a penny. And it's because the way we value collateral and the way a farmer values collateral is different. You know, we might say, okay, well, hoop house, it's just pipes and plastic. It's worth nothing, really. So if we had to repossess that, it isn't worth sending somebody out to take it apart. There's no value there, right? But if a farmer takes a loan with us and we have their hoop house as collateral, they can't afford to lose the hoop house. They have to have it as part of their production system. And so they're going to make their loan payments. They don't want to risk losing that collateral.
You have something must, like somebody buys that tractor, you obviously make them do insurance on it.
Yeah, we do require insurance.
Is that
Yeah.
listed anywhere or not?
I mentioned it in conditions, that's where it shows up. But we have, with our Amish clients, they don't take traditional insurance, they take Amish aid. So the community has, they're insuring each other. It's a formal system, but in every community is insuring every other community. So there was a wildfire in the Coloma community. You guys probably remember that a couple of years ago. There was the pallet fire, they called it. Yeah, and it burned, I forget how many acres. One of my farmers, it burned all of the buildings on their farm, except the house. The house was the only thing that they saved. But the community, not just their own community, but other communities came and rebuilt all the buildings on that farm. But that's Amish aid. So with them, we can accept an Amish aid certificate instead of traditional insurance. So we try to be flexible and meet the needs of our people.
Another question. About an operating loan and as just kind of like security for a community, you're trying to take someone out of pocket. At what point do you like look at your finances and you're like, oh, maybe I should start pulling from the operating loan? I'm sure it depends on like your expenses and your living expenses, but like at what point do you make that? Should I recommend people?
Yeah, that's a great question. So Kristen's question is, you take an operating loan and you don't really intend to use it, but at what point do you say, okay, now I do need to tap it? Looking at Angus's balance sheet, we said he had about the right amount of cash. He had 12.5% of his current assets were in cash. He could probably, if he had an operating expense come up, he could take it out of cash. But if he didn't have an operating loan behind that, he got hit with some big expense. Maybe he had some death loss, something. A couple of steers blow and they're dead. Now all of a sudden his cash flow is not what he anticipated it would be. He doesn't have a whole lot of cash to fall back on. You'd want to keep that 9,000 in cash. We'd say that's safe. You want to, that's a safe position. That's where he would want to start tapping his operating loan if he needed more cash than that.
And then 9,000, like I guess it kind of just depends on the operation, so it's kind of like representative forever.
Yeah, the working capital. So when we take the current assets minus current liabilities, it gives us that dollar figure. And we want that to be at least 15% of the gross income of the farm in a year's time. But then we just look at the current asset side and we want like 10 to 15% of those current assets in cash. Yeah. And that's where I see a lot of farms, they drive their cash way down. They only keep $1,000 in the farm checking account because there's no incentive to hold cash. If you can stop interest from accruing, why would you keep it in your checking account that's earning nothing when you could pay down an operating loan at 8%, right? But you still need some cash. You need to have some liquidity.
So I was thinking about buying a tractor. Mine's too small, but I know I don't have enough. I can run the numbers. I know I don't have enough farm cash flow to make that loan payment. But I have enough an off-farm job. Would that be something that you look at both?
Oh, yeah.
And off-farm? Okay.
Yeah. So the question is about if you're going to buy a tractor, you don't have enough farm cash flow to cover the loan payments on the tractor. Could you make those payments from non-farm income as well? And yeah, we look at it globally. Yeah, so we'll include non-farm and farm income.
Any other questions?
I-
Anyone online? Oh,
The one from Asher, way at the beginning, you talked about wing breaks. Did you? Are you talking trees or mobile or both or what?
Trees.
Just trees?
Yeah. Trees and shrubs. That's with the Central Wisconsin Woodship Partnership currently, which kind of started out as a full things.
And so how did people get to that? They're interested in it.
In the trees.
Yeah, and then
Shannon Rohde is the person who runs that right now.
So I'm a question in the chat or something.
Yeah, I had a neighbor that got through NRCS, planted like 50 trees last year. I'm not sure what specifics were behind that, but.
yeah, I don't know the specifics. A lot of these projects, I know a lot of Shannon's projects are on highway plan right now. You have to reach out to them or
That's money.
Yeah. I know a number of the projects that they do are equipped, and then some are, you know, Department of Transportation, that sort of thing. So they do a mix of types of installation. They're not always like in an agriculture context necessarily, but.
Thanks, all.
Oh, you're welcome.